Welcome. Today, we are going to build a complete swing trading playbook, literally from the ground up. We're going to break down a really powerful methodology into two super clear, actionable plays that you can start practicing right away. So let's get into it. So, are you kind of tired of strategies that are just way too complicated or, just don't seem to work out? Our goal today isn't just to show you a strategy, it's to help you really understand why it works. That way, you'll actually have the confidence to use it. Here's a quick look at our roadmap. We'll kick things off with the overall game plan. Then, we'll dive deep into two very different plays. After that, we'll get into the nitty-gritty of entries and exits, talk about the single most important role in all of trading, and finally, we'll look at why these strategies actually have an edge. Okay, first things first, let's make sure we're all on the same page. We are talking about swing trading. All that means is we're using the daily chart to find our spots, and we're aiming to catch a single swing in the market. This could take a few days, maybe even a couple of weeks. It's really that sweet spot, you know? It's not the crazy intensity of day trading, but it's also not the super long-term patience of investing. All right, let's jump right into our first play. I'm calling it the indicator combo. Now, this one's for all of you who like getting clear signals and confirmation. We're going to combine a couple of really powerful indicators to get a solid read on both the market's trend and its momentum. So, our first tools are the 50 and the 200 exponential moving averages, or EMAs for short. Put simply, these lines just smooth out the recent price action to show us the real underlying trend. Think of the 50 EMA as our short-term guide and the 200 EMA as our long-term confirmation. Together, they pretty much tell us if the bulls or the bears are in control. Next up, we've got the RSI. Now, if the EMAs are the river's current, the RSI is like the market's pulse. It measures the speed and change of price movements, and it gives us a reading from 0 to 100. We use it to spot those moments when a pullback might be losing steam, which can give us a fantastic potential entry point. So here it is, the checklist for a long entry. Step 1, confirm the uptrend. We need the price above the 50 EMA, and the 50 needs to be above the 200. Step 2, wait for a pullback to that 50 EMA. Step 3, watch the RSI. We want to see it dip into our sweet spot, that 35 to 45 zone, and then start to turn up. Step 4, look for a nice bullish candle, like a pin bar or an engulfing candle, as our confirmation. And finally, step 5, the trigger. We only buy when a candle closes above the high of that signal candle. And remember, all 5 of these conditions have to be met, no exception. And you know the beautiful thing about this strategy is how symmetrical it is. A short or a sell setup, it's just the mirror opposite of a long setup. Instead of the 50 EMA being above the 200, it's below it. The RSI rises up into the 55 to 65 zone before it starts to fall, and we're looking for a bearish candle. We literally just flip the entire logic upside down. It's that simple. Okay, let's move on to play number 2. This one is for the minimalists out there, the traders who like a clean chart. This strategy uses 0 indicators. It's all about reading the story that the price chart itself is telling you, just by looking at its structure. The whole strategy is built on one of the most reliable patterns in trading, the breakout and retest. And the psychology behind it is actually pretty simple. You have an old price ceiling, resistance, that finally gets broken. Then the market pulls back to test that old ceiling to see if it's going to become a new floor or support. If it holds, well, that's a powerful signal that the trend is very likely to continue. So, the playbook for a price action buy trade is pretty straightforward. First, you confirm you're in an uptrend by looking for higher highs and higher lows. Then, you find and mark a key resistance level. You wait for a decisive candle to close above it. Now, this next part is absolutely crucial. Do not chase the price. You have to patiently wait for the price to come back and retest that old resistance. Your entry signal is a strong bullish candle right at that level, confirming it's now become support. Okay, so we've got 2 solid plays for when to get into a trade, but a strategy is totally incomplete without clear rules for where you get out. And that means for when you're wrong and for when you're right. And this part applies to both of the strategies we've talked about. First up, our protection, the stop loss. This is your non-negotiable safety net, okay? For a buy trade, you're going to place it just below the most recent swing low. For a sell trade, it goes just above the most recent swing high. This defines your exact risk on the trade before you even click the button. And now, for the fun part, taking profits. We always want our potential reward to be bigger than our potential risk. So your first target should be at least 1.5 to 2 times whatever you risked. For example, if you risked $100, you're aiming to make at least $150 to $200. A second target could be the next major support or resistance level. And here's a pro tip. Consider using a trailing stop to lock in profits while still giving your winning trades room to run. Look, we can talk about entries and exits all day long, but none of it matters without what comes next. This is, without a doubt, the single most important part of any trading playbook. Long-term success isn't about finding winners. It's about making sure the losers don't take you out of the game. And here it is, the golden rule of trading. You should never, ever risk more than 1 to 2% of your total trading capital on any single trade. So, if you have a $10,000 account, your maximum risk on any one trade is just $100 to $200, period. This one rule will keep you in the game long enough to actually find success. And here are a few other essential rules for your playbook. Don't try to juggle too many positions, just cap it at 3. Both of our strategies are trend following, right? So if the market is just grinding sideways with no clear direction, just stay out. Avoid trading on holidays or other low volume days. And absolutely never, especially after a loss, jump right back into the market to try and win your money back. That's called revenge trading, and it is a death sentence for a trading account. So, why do these plays actually work? The source material claims they have a really high probability of success, somewhere in the 80 to 85% range. Let's break down the logic. It's not magic. It's all about stacking the odds in your favor. The indicator combo works because it layers multiple confirmations on top of each other. You're not just trading an EMA cross or some RSI signal in isolation. You're waiting for the trend, the momentum, and the price action to all line up perfectly. This acts as a really powerful filter. And the pure price action strategy, it works because it's based on the market's fundamental structure. The breakout shows intent, and that successful retest confirms that the big money has stepped in to defend that new level. But you have to remember, a great strategy is totally useless without the discipline to follow it. The market is going to tempt you to move your stop or to take your profits way too early. Just like the source material says, real success comes from executing your plan like a machine, without letting fear or greed get in the driver's seat. And there you have it, 2 complete, high-probability plays for your swing trading playbook, with crystal clear rules for entry, exit, and risk management. But look, the playbook is just the beginning. The real work starts now. You got to go back through the charts, test these ideas, and practice them over and over until executing them becomes second nature. Thanks for tuning in.